into. So you want to own a Circle K, not work at one, own it. Your name on the franchise agreement, your name on the lease, a red and white sign out front that prints money 24 hours a day whether you're awake or not. Gas doesn't go out of style. People don't stop needing a fountain drink at 2 a.m. It feels like the closest thing to a perpetual motion machine that capitalism still allows you to buy into. Here's the number that should stop you before you get any further. Across roughly 17,300 Circle K stores spread over 29 countries, Circle K's parent company runs more than 60% of them itself, directly, with its own employees and its own P&L. No franchisee and no independent dealer in between. For most of this brand's modern history in the United States, you couldn't have bought your way into this system if you'd shown up with a briefcase full of cash, because there was effectively nothing to buy. And by the end of this video, you'll understand exactly why the company that owns Circle K wants it that way. That's the part that changes everything. You've been told Circle K sells franchises the way 7-Eleven does. Buy in, run the store, keep what's left. It doesn't work that way, and it only recently started working any other way at all. What you're actually being offered, when Circle K does sell you in, is a long-term lease with extra paperwork, wearing a franchise agreement's name, and by the end of this video, you'll understand exactly why the company that owns Circle K wants it that way. Start with the comparison every viewer already has in their head, because it's the wrong one. 7-Eleven made a corporate decision back in 2007 to become an almost entirely franchised company. It worked. Roughly 87% of 7-Eleven's locations today are run by independent franchisees, not corporate employees. 7-Eleven's entire business model, top to bottom, is, we don't want to run stores. We want to collect royalty checks from people who do. Circle K's parent, Alimentation Couche-Tard, made the opposite bet. As of the company's most recent counts, roughly 10,500 of its stores are company-operated, out of somewhere around 17,000 total locations worldwide. The remainder splits between company-owned dealer-operated sites, independently owned dealer sites under long-term fuel supply contracts, and actual franchise stores under the Circle K name. And that last category, the real franchise agreements, has historically been the smallest slice of the three. In 2020, Circle K reported about 2,380 stores worldwide under franchise agreements, out of a brand footprint of nearly 15,000. That's roughly 16%. By 2024, industry trackers put the franchised count above 3,200, growing, but still well under a fifth of the system. So when you go looking for a Circle K franchise, you're walking into something the company has only been meaningfully scaling up in the US for the last few years. Nothing like the mature, decades-old franchise machine with a waiting list and a well-worn playbook you'd get from a fast food chain that's been selling franchises since the Johnson administration. The agreement runs through a specific subsidiary called TMC Franchise Corporation, which is the actual entity that signs your paperwork, not Circle K itself. And look at who Circle K is actually recruiting for its highest profile expansion. In late 2024, Circle K announced a deal to more than double its store count in upstate New York, from around 30 locations to 70. The franchisee taking on 40 of those new stores wasn't a first-time small business owner. It was the Buc-ee Group, a company that built its name as one of the largest TGI Fridays franchisees in the country, and already runs Wendy's restaurants and Hilton and Marriott hotels. Circle K is courting operators who already run multi-unit franchise empires and know how to service seven-figure debt across dozens of locations at once, not someone chasing a retirement dream with their first small business. The entry bar backs this up. To even apply, Circle K wants a net worth of at least $500,000, with $100,000 of that sitting in cash or liquid assets. Money that isn't going toward your build-out, just money proving you can survive if the store loses money for a while. Some franchise disclosure summaries put the bar even higher, at a full $1 million net worth for a single store agreement. Either way, this was never built for someone maxing out a HELOC on a starter home. Now the part where the headline number stops meaning anything. The Circle K franchise fee, the check you write just to license the name, is $35,000. On its own, that's cheap. A single Chick-fil-A franchise fee is $10,000. A McDonald's is $45,000. So $35,000 sounds like it puts Circle K somewhere in the normal range of American franchising. It's a trap, and it's the same trap every low headline fee franchise sets. The $35,000 fee has almost nothing to do with what you'll actually spend to open the doors. If you're converting an existing convenience store you already own or lease into a Circle K, franchise disclosure filings put your total investment somewhere between $268,500 and just over $3 million, depending on the site's condition, the fuel equipment, and how much rebranding the location needs. That's already a wide enough range to swallow a small house at the bottom and a small apartment building at the top. If you're building a Circle K from the ground up, new construction, new fuel islands, new canopy, new everything, the number jumps to somewhere between $1,383,500 and $4,846,500. And for a full-format flagship store with fuel bays and a quick-serve restaurant built in, total investment figures in franchise disclosure documents run as high as $8,300,000. Sit with that spread for a second. A $35,000 licensing fee attached to a total investment that can run past $8 million. The fee functions more like a processing charge than an actual reflection of what the business costs. Duh! And unlike a lot of franchises where the corporation helps by fronting capital, here that help isn't free. Circle K does offer funding assistance for construction, equipment, and conversion costs, financing packages that can run from $100,000 to $1 million. But every dollar of that funding comes wired directly into a higher royalty rate on every gallon and every candy bar you sell for the life of the agreement. There's no version of this deal where you're not the one financing it, one way or another. Here's the part that doesn't show up in the glossy franchise brochure, and it's the whole reason the ownership structure works the way it does. Convenience stores make most of their revenue from gasoline and almost none of their profit from it. Industry-wide, fuel accounts for roughly 2/3 of a typical convenience store's total revenue dollars, but only about 39% of its profit dollars. The rest of the profit comes from the snacks, the drinks, the cigarettes, the lottery tickets sold at the register while someone's pumping gas outside. That split is the entire ballgame, because of how Circle K's franchise and dealer agreements are actually structured underneath the surface. In many of these arrangements, the real estate, the land, the building, the fuel canopy, isn't owned by the person running the store. It's leased to them under a master lease agreement, typically a triple net lease, meaning the operator also covers property taxes, insurance, and maintenance on top of rent. The fuel itself doesn't get bought on the open market at whatever price the operator can negotiate. It's supplied under a master fuel distribution agreement, at wholesale cost plus a fixed markup per gallon that the parent company sets, not the person running the pumps. Add it up, and you get a business where the two biggest line items, the building you're standing in and the product that drives 2/3 of your revenue, are both controlled by contracts you didn't write, priced by a formula you don't set, for a term you didn't negotiate from a position of leverage. What you actually control is labor, the inside of the store, and how well you run the parts of the business that generate roughly 1/3 of the profit pool. Meanwhile, the parent company collects a fixed markup on every gallon, regardless of how good or bad your year is, plus rent, plus a royalty on your gross sales, which is calculated off revenue, not profit, so it gets paid whether your margins were fat that year or non-existent. This is the same trick that made McDonald's one of the largest real estate holding companies on earth, dressed up as a hamburger business. Circle K's version runs the trick through fuel pumps instead of a griddle. What's visible is the convenience store. What's structurally guaranteed and running underneath it is a company collecting rent and a locked-in commodity markup from thousands of locations it never has to staff, ensure the customer risk on, or show up to at 3 in the morning when the fryer breaks. This isn't a hypothetical risk. Circle K's own corporate history is the case study. In the 1980s, under CEO Carl Eller, the original Circle K Corporation went on an aggressive acquisition spree, buying up smaller chains across the country and financing the buying spree with junk bonds, high-yield, high-risk corporate debt, combined with a financial maneuver called a sale-leaseback, selling off the real estate underneath its own stores to outside investors, then leasing that same real estate back so it could keep operating there. It also meant the company no longer owned the ground under its own convenience stores and had locked itself into decades of lease payments to fund short-term expansion. When the junk bond market collapsed at the end of the 1980s, the same collapse that took down Drexel Burnham Lambert, the investment bank that had helped fuel the entire junk bond boom, Circle K lost its ability to refinance that debt. The company filed for Chapter 11 bankruptcy protection on May 15, 1990, and posted a loss of $773 million that year. It spent 3 years in bankruptcy court before emerging in 1993 under entirely new ownership, sold off for $399.5 million to a group called CK Acquisitions, less than half of what the company's debt had ballooned to at its peak. The mechanism that sank the original Circle K Corporation, leverage financial engineering around real estate, growth funded by debt rather than operating cash flow, and a structure where the company didn't actually own the ground it stood on, is a close cousin of the exact structure its current franchisees operate under today. The company survived and eventually became part of Couche-Tard's global empire. Individual operators who take on a highly leveraged, real estate-light version of that same model don't have a multinational balance sheet standing behind them if the numbers turn. Let's build the model with real numbers. According to Circle K's own franchise disclosure filings, the average Circle K location does about $1,310,571 in gross annual sales. Estimated store-level earnings on that revenue, and this figure comes from third-party franchise analysts reading the disclosure documents, not a guarantee from the company itself, land somewhere between $91,740 and $131,058 a year. That's before debt service on whatever multi-hundred-thousand or multi-million-dollar loan you took out to open the place. Call the Goodyear the top of that range on a store that's running well, with fuel margins holding steady. Now, take fuel margins. In 2025, the industry-wide average gross margin on gasoline sat around 39.7 cents per gallon, though Couche-Tard itself has reported gross fuel margins in the U.S. running above 47 cents per gallon in strong quarters. Strip out the retailer's actual cost of selling that fuel, roughly 20 to 25 cents per gallon in operating expenses, plus another 8 cents or so lost to credit card processing fees, and the net margin that's actually left over can shrink to somewhere in the 10 to 15 cent range per gallon, sometimes less. That's a margin that moves with the oil market, geopolitics, refinery outages, and price wars with the Shell station across the street, none of which the person who signed the franchise agreement controls. Run a store moving 100,000 gallons a month, and a swing of just a few cents per gallon, sustained over a year, is tens of thousands of dollars gained or lost before you've sold a single bag of chips. In a bad year, that swing eats directly into the low end of that $91,740 to $131,058 estimated earnings range, while the royalty payment, calculated as a percentage of gross sales rather than profit, keeps coming due at the same rate, regardless of whether your margin that quarter was healthy or had nearly disappeared. The rent on the triple net lease doesn't move either, and neither do insurance or property taxes. So good year is fuel margins holding, gross sales near that $1.3 million average, and the fixed costs, rent, royalty, wholesale fuel markup, taking their usual bite out of a healthy number. A bad year is the exact same fixed costs, taking their usual bite out of a number that shrank underneath them, because the one part of the business you don't control decided not to cooperate that year. What you actually apply for isn't ownership of a Circle K. It's a tenancy where you're also on the hook for the fuel markup, the royalty, and whatever the gasoline market feels like doing to you that quarter. An arrangement the company has only been handing out in any real numbers for the last few years.